Well, much of the high demand for air cargo capacity over the last 18 to 24 months has stemmed from unprecedented disruption to the global container shipping industry. With over 80% of world trade carried by sea, anything which upsets the status quo can be dramatic. But by almost every conceivable metric, container shipping is now in completely uncharted territory. Everywhere we look, new records are being set, both good and bad. Record US demand, record congestion levels, record high freight rates, record delays, record number of blank sailings, record low reliability, record capacity supply, record carrier profits, record low idle fleet, and record long transit times. So what have been the underlying drivers of the current global container shipping crisis? And what does the route back to normality look like? Well, to tell us more, we're now joined by Alan Murphy, CEO of Container Shipping Research and Analysis Specialists, Sea Intelligence, and a former senior analyst at Maersk Line. At this critical time for the shipping industry and for businesses around the world which depend on it, we're very much looking forward to hearing Alan's unique insight on the market.
Ladies and gentlemen, thank you very much for joining today. First and foremost, I'd like to thank the organizers at TAPA for inviting me to speak with you here today. Now, before I start in the presentation, I'm just going to give you a warning up front. There will be a lot of slides in my presentation today, many charts and graphs. I will not linger on any of them. I actually have more slides than I have minutes. The intention with this is to give you a very quick rundown of the state of the container shipping markets, which are rather much in turmoil. All of the material from my presentation comes from our weekly or monthly publication. So anybody interested in learning a bit more on the background can of course reach out to us afterwards for that. For those of you that are not familiar with Sea Intelligence, I can say that we are a dedicated container shipping research and analysis firm. I won't waste your time now with a lot of information and trying to market who we are, but there are a couple of slides in the presentation which you can download afterwards if you want to learn more about who we are and what we do. But we are focused container shipping research and analysis firm and also supply chain advisors. Now, with that, container shipping markets have had absolutely no precedence in the period from 2020 to 2021. It is completely uncharted territory that we are in. And that also makes it a little bit difficult to say anything about where we're moving to, but I'll try to do that in the end. Now, just to give you an idea of just how wide the market has been. These are the spot rates, so the spot market rates for moving a container on either Asia-Europe or Trans-Pacific. You can see from Asia to North Europe, Asia to Mediterranean, Asia to the US West Coast, Asia to the US East Coast. Now this data comes from CNETA, but any of the rate benchmark providers basically show the same picture. So from a market where spot rates range around 500 up to about $2,500, so around $1,000 per 40-foot container, up to about $2,500 for the little bit longer route into US East Coast. Spot rates absolutely exploded. First on the Asia-Europe trade in the beginning of 2020, and then also started to see significant increases on the Trans-Pacific trade. And we should also stress that this massive increase in spot rates, which has gained a lot of attention in industry and publication headlines, we went from around $2,000 and the latest freight rates on Asia-Europe around $14,000. So that's a sevenfold increase. And that's considering that on top of the pure ocean freight rates, shipping lines are charging space fees and equipment fees or surcharges, which are considerable on top of that, ranging from at the very low end around $500 to more commonly $5,000 to up to $10,000 per container. So, and those are not included here. So we're talking pure ocean rates, including these surcharges of up to around $25,000. So a tenfold increase over the traditional cost. So markets are completely in turmoil. Now, this is purely on the spot market. The majority of cargo still moves on contracts, on longer term contracts of usually at least a year. The increase in freight rates on the contract market has not been as wild, but still quite significant, with a 3 to 4 doubling of contract rates. So both the very volatile spot market, which has got a lot of attention, has absolutely exploded, but the contract market, the contracts are also subject to these additional surcharges of up to $10,000. So across the board, the cost of container shipping has gone through the roof. And while the contract market has not been quite as crazy as the spot market, we also have some indications of contracts that have been signed in just the last 3 months, and they've gone even higher. So there's clear indication that the momentum is one of increasing rates. We are actually expecting contracts to continue to rise in the coming months. So on the cost side, it's been absolutely crazy. If we look at the supply that the shipping lines have brought in, now these are the last 10 years of supply, we can see that the red lines, these trades are the Asia, North America, West Coast trade, so Trans-Pacific to the West Coast, the North America, East Coast trade to Trans-Pacific to the East Coast, and the Asian, North Europe, and Asian Mediterranean trade. And we see that initially in 2020, when the pandemic first hit, we saw a withdrawal of capacity down to a low level. But in the second half of 2020, supply was higher than it had been in any of the previous 10 years. And this has continued into 2021, where supply has been higher. On all trades except for the Asian Mediterranean trade, it's been higher than anything that we've seen anymore. So a massive explosion in rates, a vast growth in the supply of container shipping space. Now, the indications for the fourth quarter are still indications, and we also know that a lot of these might end up being cancelled sailings because the vessels simply can't make it back out to Asia in time for the regular sailing. And that brings me to another point. We refer to cancelled sailings as blanked sailings, which is just a bit of newspeak. It is effectively the wholesale cancellation of a sailing. Now, what we've done here is, rather than the number, is usually not a good guide, because the size of the vessels vary quite considerably across the trades. But what we've measured here is the Asia-Europe capacity that's been blanked, measured in nominal TEUs, both in Asia-Europe and Trans-Pacific. And while it has been swinging around from 200,000 up to 600,000 at most, per quarter over the last 10 years, we see an absolute explosion in the cancellation of sailings measured by the supply that's been removed. There was a small dip in the third quarter where we saw a lot of sailings that were scheduled to be cancelled be reactivated, and that's because the blanking or cancellation of sailings have been driven by two separate factors. In the first half of 2020, we saw a massive decrease in the number of containers wanting to be shipped. And the shipping lines, in order to maintain utilizations of the vessels, started canceling sailings. So in the first half of 2020, these high jumps in cancellations or blankings were because the shipping lines were basically trying to balance supply to demand. Since then, we've had an explosion in demand, and then you might think, but why on earth are the shipping lines cancelling sailings? But these sailings that have been cancelled since the second half of 2020 have been because the vessels have been stuck in congestion and simply have not been able to make it back in time for their scheduled sailing, meaning that the sailing have been blanked or cancelled. So an absolute explosion in the cancellation of sailings. Meanwhile, if we look at schedule reliability, that's the percentage of vessels that arrive on time, and our definition is relatively forgiving. We count a vessel as being on time if it arrives within plus minus 1 calendar day of the scheduled arrival. This has been varied a bit across the main trade lanes. I've done here the blue lines, global deep sea sailings, Asia, North America, West Coast of the Trans-Pacific trade, and Asia, North Europe. And what you'll see, while there's been variability in schedule reliability, vessels have been on time on average around 70%, both globally and across these major trade lanes. There's a big dip in 2015, and that's because we had a labor dispute in the US West Coast ports. But what we see is since the second half of 2020, schedule reliability has absolutely tanked. Globally, we're looking around 35% vessels, so 35% of vessels arrive on time, so about 2/3 of all vessels arrive 2 or more days late. And on Trans-Pacific, it's even worse. We're down at around 10% of the vessels being on time. Asia, Europe, around 22%. And likewise, if we instead of look at reliability, we look at the average delay. The average delay of vessels has been around roughly an average of 1 day late. So on average, across all the sailings, both those that are on time and those that are late, the average has been around 1 day. Little bit higher in Trans-Pacific, and you also see that labor dispute that we had in 2015 meant that we had very high delays, but for a very short amount of time. Now, in recent months, global and Asian Europe delays have steadily over the last year increased to up to about 5 days right now. On average, all vessels are 5 days late, and it's absolutely exploded on the Trans-Pacific to North America West Coast trade, where delays are now up past 10 days on average, and that's across all sailings. So we're basically in a situation now, if you are a cargo owner or shipper, a customer of the shipping lines, you are getting the absolute worst service that has ever been provided. And not only is the service when you get it incredibly poor, there's a lot of sailings that don't sail, which means that you're actually not even getting a service. And when you're getting this incredibly poor service, you are getting it at the highest prices you've ever paid. So unsurprisingly, a lot of cargo owners and shippers are quite upset with the market situation. Now, what is then driving this? If you follow the industry media on container shipping, it does seem like there's an absolute global demand boom going on, and that's what driving this very disrupted market. And if there's one thing I want to get across to you is that there is absolutely no global demand boom. That notion is wrong. And why do I say that? Well, if we look at global container volumes that have been moved, or global container demand, I've done them here. These are data from Container Trade Statistics. This is data that comes from the shipping lines themselves. And what we see is, certainly if we look at, on the right-hand side, the year-on-year growth, it does look like we've had an absolute boom in the first half of 2021. It does look like we have had year-on-year growth of up to 20% in some months. That does sound like a boom. But that's only because we're comparing in the first half of 2021 against the massive drop that we saw in first half 2020. We think a much better measure to basically bypass this exceptional drop in demand in the first half is to look at the growth over 2 years and then average it out annually. And what we see is that global demand is only about right now around 2.3% in the latest months. So a very, very, very reasonable demand growth. Anything under 5% is what we're used to in the industry. So globally speaking, we're not seeing a demand boom. Now, well, how can we then have these issues? Because the growth in volumes, in container volumes, is not equally spread around the world. Now, what I've done here is I've taken the 7 import regions, and the red line with the blue dots indicate how big the market is. So the Asia import market accounts for about 40%. So by far the biggest import market, but you also see that the growth in that market has been relatively modest, around 2 to 3% most months. If we look across all the regions, the only significantly large region is the North America import market, the NAM import market, which accounts for about almost 18% of global imports, and it has been growing at about 5% in every month over the past year, and at some point up to 10 and even 15 months in February 2021. So we are seeing a demand boom, but it is concentrated to North America. You might say, but what about the other regions here, so Latin America or Africa or Oceania? While they have been growing higher than the past, their relative market share means that they're not that important. And a different way to look at that is we've compared every month from a global perspective, the global TEU volumes being moved. And what we see is that what I've colored here is the relative contribution from each of these regions to the global either loss or gain over the same months in 2019. And the overall takeaway here is the purple one, North America. Since the return of the market in the second half of 2020, the overwhelming contributor to the global demand has been North America demand. So the key takeaway here is we do not have a global demand boom, we have a North America demand boom. And just to put that into perspective, on the left-hand side, I have the TEU volume imports in nominal TEUs, and the growth rate on the right-hand side. And again, if you look at the year-on-year growth rates, you're going to get a wrong picture because you'll be comparing the current developments against a massive drop in the first half of 2020. Rather, we recommend doing 2-year annualized growth. And what you see is that we have had substantial growth of around 10% for now over for close to a year. And that is a lot. It's not wild. If I go back to when I was working on the other side of the shipping line, we easily saw Trans-Pacific growth rates of 15-20% in the decade before the financial crisis, so from 2000 to 2009. So it has been very strong growth into North America. And North America is the only region that's growing, but it's not wild, insane growth. And the takeaway from this is that the challenge that we're seeing now, we would have seen them at normal growth rates in a couple of years. They've just basically been moved up. So again, growth of around 10% going into North American TEU volume demand. And that has been the initiator of the current crisis, but it's not the main driver of the current crisis. Now, just to explain why have we seen this demand boom into North America. Now, I've looked here the last 18 years of consumer spending across the three main groups that the Bureau of Economic Analysis splits the data into. Services, which is the blue line, non-durable goods, which is the red line, and durable goods, which is the green line. Now, these are the growth rates 2-year annualized. Again, so that in 2021, we're not comparing to this massive dip in 2020, we're comparing to 2019, basically in 2021. And what you'll see is we've basically seen a shift where growth in services and durable goods has generally been around 2 to 3% 2-year annualized. But durable goods have massively exploded. Now, the underlying reason for that, if you have the mental image of an American who cannot go to restaurants, who cannot go to bars, who could not go out and spend, Americans spend about 60% of their disposable income on services. That's not been possible during the pandemic. So they've basically, the mental image of Americans sitting on this couch and ordering stuff off Amazon is not entirely wrong, because that's basically what happened. And that massive explosion in durable goods demand that we see here in 2021 is the underlying driver of this North America import demand boom. But the crisis itself is actually not the demand. The demand is the initiator. The volumes moving into North America is the initiator. But the actual crisis comes from the the congestion that this massive demand has placed on the North American ports and hinterlands. Basically, it's not so much the ports, it's the depots, it's the container yards, it's the distribution centers, the trucking, rail, everything in the North America, especially in the US, has been clogged up. And as that clogging up happens, the ports are also getting congested. You've probably seen that we now have more than 80 container vessels waiting at berth outside Los Angeles and Long Beach. And that means that I've done this for the Asian North America West Coast and North America East Coast trades, that we're seeing right now that almost 30% of all of the capacity that's been supplied into the West Coast Trans-Pacific market has been lost. It's 19% for full year 2021, or year to date 2021, but it's increasing. So we're seeing more and more of that capacity supply simply being stuck, not being used because it's stuck congested outside of ports. From a global perspective, about 12% of container capacity is being soaked up by congestion, meaning that it's simply not moving containers because of these massive delays. And that's the largest we've ever seen. So all of this congestion is basically adding the same as if global demand had grown at 12%. So massively congested markets is the underlying cause of the crisis. And adding to that, because all of these vessels are being congested, as they're coming back out to Asia, they're going off schedule, and we see that the number of services, which usually there should only be one vessel on a weekly service or one vessel every week, we're seeing that the percentage of services that see more than one sailing on a weekly basis has increased because all the vessels are getting bunched up and can't depart on a regular schedule. So ports massively congested, vessels waiting outside, and services no longer being weekly, but rather being haphazardly bunched together. Now, all of that seems disastrous, and it is. It's absolutely the worst crisis we've ever been through. But there's one entity in this whole debacle that's actually have come out rather well on top of this, and that's the shipping lines. Because when freight rates explode through the roof, their revenues, of course, increase. Now, we've looked here at all the second quarters. We don't have third quarter data yet. It's not been published by the shipping lines. But if we look at the average freight rate that the shipping lines have been charging over the last 10 quarters, we can see that the second quarter of 2021 have seen the average freight rate earned by the shipping line has increased quite considerably. It's important to stress that we're nowhere close to the $10,000 to $25,000 that we see on some markets, but the average rate has close to doubled for many of the shipping lines. That also means that the revenues in the second quarter of 2021 have grown quite at a level never seen before, record increases. Hapag-Lloyd grew their second quarter year-on-year revenues by 64%, which was the lowest, all the way up to Sim and Wanhai, who have seen 200% increase in their revenues in the second quarter. And remember that they're not moving that many more containers, they're just moving them at a whole lot higher price. And that also means that their earnings before interest and tax have also shot up very, very significantly. It doesn't make sense to do percentages for some of them. It's been like 6,000% increase in their operating profit. But we've done the 2021 compared to all the previous years, all the previous 10 second quarters. And the takeaway is that in the second quarter of 2021, they've made more money than they've made in the last 10 second quarters. And to flip that around and look at what has been the shipping lines earnings before interest and tax per TU, per 20-foot equivalent unit. In the past, I would often mention that some of these shipping lines have a tendency to lose money every time they move a container. That's certainly not the case anymore. You see the red lines. In the past, the best year we had was 2010, where the shipping lines had an operating profit of around $200 for those who are doing best. That's been absolutely blown out of the water. The largest shipping lines have been having an operating profit of roughly 600 to 800 US dollars per 20-foot equivalent unit. But even for the smaller ones, they've seen an EBIT per TU of $1,000 to $1,200 per TU. So the shipping lines are absolutely flush with cash from this. It should be stressed, the shipping lines did not cause the crisis. This crisis was caused by the pandemic, a shift in consumption, especially in North America, and the massive congestion, which is primarily driven by the hinterland. So while they didn't, so to speak, create the crisis, they certainly have come out of it quite well. This all leads us back to probably the question I get more than any other question is, how on earth do we get back to normal? And what is normal? I'm going to try and end on that. And I should also say, any person who says they know exactly what's going to happen, have just proven how little they know. And I'm not going to claim that I know exactly what's going to happen here. We do know a few things. We know that this crisis must be resolved on the demand side. For the simple reason we've run out of vessels. There are no more vessels. Everything that can float is floating right now. All the vessels are deployed. The shipping lines have even, regular maintenance is being held back. They've chartered in vessels, multi-purpose vessels from Africa trades, bulk vessels. Anything that can carry containers is being deployed. New vessels, unfortunately, they take 2 to 3 years to build, and there's no new vessels coming until 2023. Remember, the shipping lines have just come out of a 10-year crisis before that. They were not ordering vessels. And also right now, if we magically could materialize, 500 new vessels, that would probably do more harm than good. The problem is that the vessels can't unload their boxes. So even if we took even more boxes on magical vessels from Asia, they would just be stuck outside of Los Angeles and Long Beach. So it needs to be unclogged on the demand side. Also, it's only North America seeing the demand boom, so we can really ignore trying to fix the problem in other regions for now. But with the route that I'm planning out or charting out now, we should also remember that the system is so tightly wound right now that any major shock can have long-lasting effects. So worst case scenario would be a widespread COVID infection in China that closes 5 major ports. Then there's no way out of this. Canal blockages, the Ever Given got stuck into a Suez Canal. That would have been a problem in the past. It became a systemic problem now because everything is so tightly wound. Port closures, like we saw in Yantian and partially in Ningbo, would have been a small problem in the past because whatever you needed to move out those ports, you just put it on the next half-empty vessels. But all the vessels are full. So if the U.S. hinterland needs to be unclogged before we can unclog the ports. Those are the things that we know. So the U.S. ports need to be unclogged, but in order for that to happen, the U.S. hinterlands need to be unclogged. It's not the ports that the problem is, that they can't get the containers out of the ports. In order for that to happen, North American import volumes need to come down to the long-term trend. For that to happen, U.S. consumer demand for durables need to come back to normal. For that to happen, it means that U.S. retail and wholesale sales need to come back to a long-term trend. In order for that to happen, the current stimulus that have been the reason why that consumers in the U.S. have been able to shift their consumption from services into durable goods is because they still had money, and a lot of that money has come to stimulus. for them to shift their consumption back onto services, the restrictions limit, so lockdowns, masking, all of these things that limit service sales need to come back to normal, which means fundamentally that the US pandemic needs to disappear or be manageable. Before that happens, we're not really going to start this chain going back to normal. And even when we reach point 8 here, there's still, we need to have those congestion-induced delays come back to normal. And on top of that, retail inventories are the lowest they ever been in the US. Those retail inventories need to be filled. And to briefly show how what needs to happen here. The first thing I tried to just Google, when will the pandemic end? And unsurprisingly, as a container shipping analyst, I don't have a magical answer for you. And nobody seems to know when the pandemic will end. So we don't know what the timeline is for this to come back to normal. How about the restrictions on limits and services going back to normal? Again, we're not pandemic experts. I can't give you any expert knowledge on the pandemic. You probably know more yourselves than I do. But I did look at it, and there is restrictions have generally been lifted. Mandates have been lifted to some degree, but masking is still required, and masking does limit how much people go out to restaurant, bars, and other services. COVID is by no means over in the US, and nobody can say with any certainty when that will happen.
Alan, sorry to interrupt you. Just to highlight to you, just got 3.5 minutes left, or just a bit less than that now.
Yes, and that's all fine. Thank you. The stimulus packages, just to give you an idea, these are since 1960. So 60 years of US government spending on social benefits to persons. That has absolutely exploded. It has, so to speak, seemingly come to an end now. But if for some reason stimulus is brought back, well then demand will probably continue to be high. If we look at retail sales, the sales by the major categories, we have seen an explosion in US retail sales and wholesale sales. And those need to come back to normal. And it's hard to say how long time that will take to come down. The shift in spending from services onto goods. This is the market share. As you see, it's only a very small dip, it seems, but that is the underlying driver. Durable goods spending, as I said earlier, has exploded. Even when we look 2-year annualized, that seemingly is on the way down again. But there's no guarantee that it'll be continuing on its downwards progression. Number 6.6, the North American volumes need to come down to the long-term trend. This red line is the long-term trend, which we need to come back to. The question is, how do we come back? Is it next month? Very unlikely. Is it in 6 months? Or is it at the end of 2022? I don't know if we're coming back to the long-term trend. I can't tell you if it's going to be the first, second, or the third. The hinterlands, right now, dwell time for shipping containers are at the highest they've been in a long time. Truck availability across North America is absolutely pressured to the high point. That needs to be unclogged. How long time will that take to unclog the hinterlands? I don't know. And even after all of that unclogging has happened on the hinterland, how long time will it take to unclog? Well, on the right hand is where we have right now. So that's just using as an example, Los Angeles, Long Beach, how many vessels are currently not waiting outside, but on their way into Los Angeles, Long Beach. We were roughly at the same point in time in 2015 during the labor dispute. And it took about a month when basically the US labor in the North America West Coast ports decided to go back to normal. It took about a month to unclog. But if we look at how long it took before vessels stopped being massively delayed, it took about 3 months to unclog. And finally, the US retail inventories, they are now at they're now back at 2014 level, 2015 levels for retail. The others are okay. But if we look at it at US inventory to sales, It's never been below 1.4 for retail. It's down to 1.1. So for every dollar you sell, you only have $1.1 in inventories. That needs to rise up to 1.4. Taking that all together, how long will it take for the pandemic to be over? 3 months, 6 months, 1 year? More? I don't know. How about the restrictions on services? 3 months, 6 months before that comes back to normal? Your stimulus come back to normal, what, 2 to 3 months maybe? All of these points, we can only guess how long time it takes. Now, these are not all sequential, but there's a lot here. Now, based on that, we don't expect markets to come back to normal before the end of 2022. That's our best guess. It's not certainty in any way. It could be longer. It could be shorter, but I think that's very unrealistic. That is the end of my presentation. Thank you so much for your patience with me. For those that want to learn more about us, you can visit our website or LinkedIn, or just drop us an email if you have any questions. And all of the stuff I've gone through today, always feel free to reach out. We're always happy to talk. So do feel free to drop me an email. Thank you very much for your time.
Alan, thank you so much for a very comprehensive presentation. Unfortunately, we won't have time to get to the questions today, but what we would like to do is put those into Tapper and Mia's Vigilant magazine. So we'll have some answers for you there, because I know there were lots of questions for you, Alan. And just finally, we've also had lots of requests for copies of Alan's presentation. So with Alan's approval, we will make it available, thank you very much, after the conference ends.